Hey everyone, in this video, Chart Guys Lamont is going to go over his initial swing report pick of Microsoft for the first 3.5 minutes, and then after that, he's going to talk about how he uses volume profile for targeting when determining where we're going to look to take profit on a trade.
All right, and then finally we have Microsoft. So Microsoft, bit more, it's a very similar setup. We are looking for a balanced play again. We're looking for responsive trade within this prior structure, which is also this guy. And you can see how there was all this mess in here before. So although the official target is 258, I have a feeling that if these buyers are going to persist, that we could probably move all the way up to like 275-ish, because essentially with this structure, we'll be back in play, right? So over here, you fail, right, to see follow through over the this value area high of this guy. And so you don't make it all the way there, but all of these attempts to get to this lowest structure have failed. So now if you were to get back over it, the next logical place these buyers should be trying to get to, if they can clear this high, should be up here at 275. That being said, official call is just for a backtest of this area. You can tell this very contentious level tries to hold price over here, resist price over here, resist price over here, holds a really clean backtest. So pretty much looking for dips down like this or like this on a backtest, looking to get to the other side here, test that major trend line, and ideally hold a runner for, a little bit higher here. And I think indicator wise, the only thing that was notable was the monthly TD support. I think this is probably the most notable thing. It's never broken. Literally never. It's pretty wild. I've never seen a chart like this before. So the TD support, I mean, yeah, that's very notable. And so we just came down and held the backtest of it, came just shy of it. Now, this is also the first time, however, in a long time, that TD resistance has printed down. That being said, if this closes as a green 1, again, the official play is really perfect. It's a perfected 9, got the green 1. So if you get that 2 over the 1, that's the official entry. All right, so let me see when there was a here's the last time that happened. It's very similar. Did it come down to the only difference is we didn't come down to the Vegas waves, but it's very similar. Perfected 9, right? Tested the TD support, green 1, green 2, that's not the signal. The green 3 over the green 2, that's the signal. Stop over the 2, under the 2. So that's the last time that happened. It hasn't happened. I don't think it's ever happened before. So that's before that time. So that's the only instance. Pretty crazy. Only other instance, it's pretty crazy. So that's all we have to compare. So I think that's quite notable. On the weekly time frame, we did lose TD support. That's not great, but the Vegas wave seemingly catching price here. That was it. That's the only notable thing. I mean, these traditional moving averages, but not really putting much weight in that. All right, that about covers it, I think. Thanks for tuning in. I appreciate y'all sharing some of your afternoon with me, and I hope to see y'all soon. Hope you enjoy the rest of your weekend. Farewell. What's going on, everybody? Hope you are doing well. Just wanted to go over a few ideas that we use regularly to scout trades for the swing report. So really the first idea is really just that volume profile analysis is much more powerful as a targeting tool than an inflection point tool. It's just as powerful to look for potential inflection points, but there are no tools out there that can guarantee with any kind of reliability at all whether or not an area will be an inflection point. So in that regard, I think volume profile is just as good as others. Personally, I think if you understand the nuance of it, it's actually better. But where it really shines is targeting. And the reason why it really shines is targeting is because the markets can only do two things. It can only balance and trend. And by balance, I just mean that it goes relatively sideways. And by trend, I just mean that it's in price discovery. It's looking for another area of high volume, or it's going to establish another area of high volume if you're dealing with like blue sky breakout or if you're in the middle of nowhere or whatnot. So let me just show you what I mean with that. So for example, here we have this prior area of balance. And well, actually at this point, technically it was up until here. So I'll just adjust this for now. Okay.
And really what we want to pay attention to is this high volume area where most of the volume was traded. Honestly, this high volume area also had a lot of price action hanging around here, right? Like if we were to highlight this and then highlight this and then look over here, and you can see how it gets really messy here. But what I really care about is after you re-enter a prior area of balance, the first place that the sellers, in this case, because we're coming from above, should be looking to get to is the point of control, and they pretty much run right to it. If you clear the point of control, they should look to test the other side of value, which there's actually quite a lot of volume traded there as well. So that's the general idea, right? And you can see how this plays out time and time again, where if you break back above the structure, but you can't find follow through, the first place they run to is going to be the POC. If you can't break below that area balance and you don't see follow through, the first place they're going to go to is that POC. They're going to just run there. And if you can't clear the POC, you're going to come right back down here. Eventually, if you do clear it, you're going to test this. That's just how it goes right here. Look how resistant the point of control was. And I believe that if we re-enter here, is very similar, right? Where you pop in, they're trying to get to the POC, they fail, fall back out, but you can't move to the next structure lower, boom, right back up to it. In fact, you gap over it this time. Okay, and you'll see this happen time and time and again, where, I mean, here you have more examples of it, right? Where again, you break into the range right to the POC. If you crack the POC, down to the VA low. If you can't break the VA low, back to the POC. If you can't get to the VA high, down to the POC. You get it. It's pretty much, that's the idea. Here you have another nearly perfect test of this high volume area. So here's the POC of this prior area balance. And you'll see once we break back into it, boom, it runs right there. Do I know that it's going to turn there? I have no idea. But do I have very high confidence that it's trying to get there? I do have very high confidence that it's trying to get there. So that's kind of it in a nutshell. You can see again another example over here, right? Where you have this, this is actually our key structure that we're going to talk about. So here's that key structure. And you can see that after price broke out of it, failed to get to the POC above, come back down, holds it nearly to the tick, and then they try to move higher, fail again. You run right to the POC, and then this POC is problematic here, and it's here, problematic here. Intraday is problematic here, problematic here. Finally, they get over it, but they can't hold. You move right down to where? The next lower point of control, right? So that's simply what has to happen. And the reason why that has to happen is because the market is designed to distribute goods effectively. And so how can a market distribute goods effectively? It must find the fairest price to do business at any given moment. That's just how every single market has to work. And so if you are aware of where the market has traded a lot of volume in the past, well, then you can get a pretty good sense of where it's trying to get to based on where it just fell from or where it just turned from. Here's another really great example of just boop, moves right down to this big POC and then the move gets going again, right? So think about it, right? If you're going to lose this point of control here, then they should be trying to move lower unless you can get back over the point of control with some acceptance. They don't find acceptance, they move lower, you lose the value area low. Okay, eyes on this low here, you lose that low. Okay, eyes on this structure down here, lo and behold, it's right down to the point of control. Okay, and so now it brings us to our, oh, look how neat that is. Honestly, it's even a small one there. Anyway, so that brings us to our current trade or recent trade setup in Microsoft. And in Microsoft, this was our key structure here, this guy right here. Why? Because, well, these buyers tried to use it as a launching pad for higher highs. They failed to do so. Then you roll under it and it becomes resistance throughout all of this. Resist, 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 resist. Boom. Finally, we clear over. And on this day, we had we were looking out for this potential play. Why? Because it would essentially be the opposite of this. A back test of this structure, right? And if they can't get through it, they're probably going to move up to the next point of control here. Okay? So, oh shoot, I forgot to copy the stuff over. Oh darn. One moment here. I do apologize for this. I think it's not much though. It's perfect actually. So here we go. We can just copy this over. Oh, I guess I should copy this better so it's not so big. One moment here. All right, so that's pretty much just the VP concept, the volume profile concept that I would like to discuss. And then it also covers our second point, the idea that once you pass over the structure, if there's a lot of follow through, it should flip, right? So if it was resistance before and you break it with a lot of follow through, it should flip into support. That was the idea here. Okay, and so here you have the alerts that we sent out for this. I could have swore I made an update about it being in the trade zone. Oh yes, there's one post below. Wait, there might be even another one. Hang on. No, that's it. All right, so here we go. So these emails, they go out, you know, as they're relevant. I send them out as soon as possible. And so on 131, we were just talking about how it is now, let's see. Yes, that this, we're just letting you know that it came into our trade zone at January 31st. That's here. And that FOMC is coming up, so just got to be sized appropriately. And sometime during the day, once this move got going on the first Wednesday, the first here at 2:44, that was like a tiny little 1-minute bull flag, I believe. And this brings us to the final key idea for this, I don't know, lesson, whatever, educational video, I don't know. So at 2:33, right? Let's see, what was that? 2:44. What was this? I don't even need to look at it. It was this. We had this one little tiny little bear bull flag here, and at 44, so it came out like a minute after the break or so. But the idea was we had made a new high. There was the overall market had been reacting positively to, I forget, honestly. I guess it was FOMC, right? Yeah, it was reacting positively to whatever they said, whatever the banker said. And at this point in time, here, let me mark it with a cross, I guess. Where is that thing? All right, so at 44 is when the alert goes out, and then at this point in time, price is here, right? And so it's flirting with that breakout. So you have to put that all together, right? We just held this area. And so if we're going to hold this area, theoretically, price should try to get to the next area of high volume, which is that POC above, which is why our target was here. And so, and so from here, the trade literally lasted like nothing. Well, I mean, my personal trade. I mean, it's because I day trade futures. I don't, you know, if I trade these names, it's usually through options. And so again, brings me to my final point. You can be late. You can be late to this and still be fine because of how confident you can be with the targeting. So because this inflection point has occurred here where we thought it might, now we have a pretty good idea that the buyer should be trying to get here next. So even if I'm late and I'm not initiating here, what I can do here, oh crap, I should have highlighted. Hold on a second here. Right, so all right, so at that point, you can, you know, very easily verify the, I think you can chart those vertical spreads, but the you know, the alerts coincide perfectly with these exits, right? So the idea was just that even though you're here, you can put oh man, I should have, whatever, the size is there for you to see. So the yeah, the risk is capped for you, right? The risk is capped because these vertical spreads cost 273 per spread, and I bought 10 of them. You know, in total, that's your max risk, right? 273 bucks times 10, 2,700 bucks. That's your max risk, right? You cannot lose more than that on this trade, even if it goes completely to zero. Which, you know, because they were February 10th, they're not going to go to zero. They still have a bunch of time value left on those, right? So even if this rolled over, the most I could lose is whatever I paid for those calls. So if I stopped out of those calls, then and my max risk was however much I wanted to lose, however much I paid, that's my max risk, 2,700 bucks. If I stop out anytime before expiry, there should still be some value in there left, and so I will never hit max risk. That's actually probably another key idea that was good to talk about. Well, essentially it's tied in with the key idea that options can be a really good way to manage your risk. People typically associate it with like higher risk stuff, you know, it's riskier or whatever. Not so, you know, you don't want to blame the tool, right? It's always a matter of how you use it. You know, I don't really mean to stir up any controversial topics, but you know, even a gun, right? Yeah, it can be used as a weapon, but so can a spoon. You know, so it's really a matter of the operator and how they use it, you know. So by capping your risk, laying out, but you know, setting your risk with however many, you know, whatever the cost of the debit laid out is, that's a great way to manage your risk. Now I don't even care what happens, right? It can roll over, it doesn't matter. I know I'll never hit my max loss. So fortunately for us, for the swing report gang, I just put out the alert very soon, like on the same day at 3:42. At that point in time, we had the bull flag had confirmed. So at 3:42, oops. 342, we were here. Okay, we had confirmed and we had moved higher, and so the premium got pretty wow, that 42 was the top of the day. Nice. But that alert went out and I just chopped it up there just so that I can start, de-risking, clearing some profits so that even if I were to have, a loser on the second leg of the trade, at least it's much further from the max loss. And then fortunately for us, we got the gap up open the next day. And, I probably could have held some runners. Honestly, I was sized fine to hold some runners, but I just closed it all out the next day because I just want to day trade futures. So, but that was it. But if you did follow these trades, and I know some of you did, then perfect. You could have rode your runner position into even now that runner position is totally fine. Right? So comes to the trade zone, gets the target. Right now, like if you're in this trade, your stop can be right here. You're very comfortable, So that's about it. That covers all the main ideas. Appreciate you tuning in. Appreciate you sharing some of your time with me. And if you're interested in learning how to get this kind of a thing done, then check out the swing report. All right, farewell.